Clinton Wilkins, are you having a good time so far?
I'm having a great time.
Why do you have such a great time doing this? Because you really genuinely like doing this.
Yeah, I love education, and I think we'll just do another shout out. We're not sure what's going on with the storm because we recorded this on Wednesday night,
Yes.
and we hope everybody is staying safe. And I hope it just passes our region.
Yes, let's
And,
hope it's
you know,
nothing for us.
Batten down the hatches.
That's right. Be prepared, right?
Be prepared.
Okay. So being prepared for what happened with the Bank of Canada over the last year plus. We know that during the we go back to 2020 or whatever it was. I mean, rates were historically low. Basically, money was free at that point. Correct?
Pretty close to free.
Pretty close to free. And the messaging
Almost free.
and the messaging that we heard consistently, at least what I heard consistently, being in the news cycle, was encouragement to get out there and borrow. Now's a great time to borrow, and people did that. And I've heard criticism within the media or from some people in media sources saying that a lot of that was not responsible advice, based on the fact that interest rates could and would likely go up. Now, a lot of contributing factors went into inflation, like the pandemic, supply chain, and all that. But do you think that in retrospect of all the advice to borrow and get a large mortgage based on low interest rates, was that perhaps not the best advice at the time?
Well, the governor of the Bank of Canada said that interest rates are going to be low for the foreseeable future.
Right, yes.
So that's really the authority on what's going on with rates. And if you took that advice, which I think a lot of people did, economists took it, we took that advice, borrowers took that advice, that was all in the media, then we proceeded down that path. The one thing we didn't know about was inflation. So inflation was not out of control at that time. Inflation was below negative at some points during the pandemic.
Yep.
And the one factor that we forget about here is during the pandemic, borrowers paid off so much debt. Canadians paid down their debt. They were not outspending. And then things changed. The situation changed. People saved money. They started being able to go out and about again, and they started spending.
Yeah.
And inflation became a runaway train, and that's the one thing Bank of Canada was not banking on.
Yeah.
The bank was not banking on inflation becoming a runaway train. And they waited too long to start increasing these interest rates.
Yeah.
So then they had to increase them faster and higher than probably anyone really expected. And I think when interest rates typically go down, they go down slowly. And when they go up, they're increasing them more quickly to be able to stay the problem, right? Which was inflation.
Yeah.
And, inflation is going in the right direction. There's been little bumps where it's like increased a little bit, or it hasn't been as low as they wanted. So they've had to increase rates. But inflation is going in the direction that we need. The one thing that is really not where they want, which is a consequence of, having inflation going down, is the job numbers are still very strong. And that's a concern for the Bank of Canada because we're not seeing the losses that they thought they were going to see as a result of the increases going up. Because we need to remember, it's not just borrowers that are impacted by a higher cost of borrowing. It's businesses, corporations. It's their access to credit and their cost of capital. It has a huge impact here. Canadians, by and large, borrowed money with mortgages because the rates were very low and they thought they were going to be low for the foreseeable future. They were not low for the foreseeable future. They actually were low for a long time, and then the last 18 months we've been starting to feel pain. They were low for a lot longer than they've increased. But we have very short memories, I think, as borrowers, and we have very short memories as Canadians that these rates were low for a long time.
Yeah.
And they went down even more during the pandemic, but they were still low before the pandemic.
That's right.
Right?
Yeah.
So we're only really feeling the pain the last 12, 18 months. And honestly, my prediction, and I will fall on this sword, I will say this right now on the record, on our show, I think if inflation stays where it's at or goes down, I think the Bank of Canada will see by next summer, the rates will start to soften.
By next summer?
Next summer, they will start to soften.
To what degree?
I think it's going to be a very slow burn on the way down.
Yeah.
Very, very slow. So I think it's going to take some time. I think we're going to, when we start seeing rates go down, they're not going to go from where they're at now to where they were during the pandemic. That is not happening.
Right.
When they start going down, it's going to be a slow burn on the way down. I think we're going to see those 25, 50 basis point decreases on the way down.
Yeah.
Slow step, slow step, slow step, because the Bank of Canada doesn't want to put the fuel on the fire, right? They don't want to reaccelerate the economy. They don't want to reaccelerate the housing market. And the one interesting thing is, here in Halifax, our housing market is still very high demand.
Mm-hmm.
We're not seeing what's going on in Ontario and BC. We've not seen prices go down or demand go down. The challenge here is supply. I read an article before we started our show that supply is moving in the right direction, but the government of Canada thinks that it's going to be another 7 years plus
before they catch up.
Before they can catch up to where we need.
Right.
I think in Halifax, it's going to be longer than 7 years.
Yeah.
I think it's going to be 10 to 20 years before supply catches up.
Tell me about some of these large buildings, and we see them all over the city. I mean, big, tall buildings, skyscrapers, not skyscrapers, but for Halifax standards. I would think that the borrower, and this might be a little out of the scope of what we normally talk about, but I would think, but for that buyer, they must have immense pressure on them, or that builder, that developer, right? Because there would be tens upon tens of millions of dollars going out the door before you see anything coming back in.
Yeah, I think the developers that are doing these big projects have deep pockets.
Yeah.
Honestly, they have deep pockets, and I think a lot of these, we'll call them deals, were done pre-pandemic. These deals have been in the works sometimes for 5, 10 plus years before there's even shovels in the ground. And I think that's the challenge with developers and development in general. The planning just takes so long to be able to get that finished product out to market. But we have such a demand here that we need to do whatever we can to get these developers to continue developing.
Yeah.
We need the rentals. We need the condos. We need the townhomes. We need single-family homes. We need all types of housing, including affordable housing, here in our city to meet the demand.
So what's the affordable model look like then? How does that work? Because, I mean, obviously, I don't know that we would need a crown corporation building houses. I mean, that's probably the last thing we need, right?
Yes, or maybe it is a public-private partnership.
Yeah.
Maybe that would work better.
Yes.
You know, I think we've had and we've tried the crown owning real estate in the past.
Doesn't work.
And that model is not great.
No.
You know what I mean? I think private owners do a better job at managing real estate.
Yeah.
And in my personal opinion, even for affordable housing, I don't think the government really is in the business of housing. The government is in the business of business development and maybe incentivizing private owners to do it, because private owners have more maybe skin in the game and they have the asset, where the government, they don't really care about the assets and the liabilities as much.
Right.
The government debt outweighs their assets in most cases. Yeah. Right.
But I would think though, with like, there's a lot of talk about houses being unaffordable, rentals being unaffordable. But obviously, people are paying this rent. There are people out in here in Halifax that are willing to and will fill those vacancies. Right?
And I would venture to say, Todd.
Yeah.
And you know how our real estate prices have increased. I think our rents have increased faster than our cost of real estate.
Right.
I would venture to say that
because
the rentals, I think, have the most demand right now because it's 1% vacancy.
And people are paying it, right?
People are paying it,
right? And
we did a special feature on your radio show about people are becoming more creative with housing. We're looking at maybe generational housing, or maybe it's 3 or 4 people getting in on a housing situation. Yeah. Because of the prices. To buy a home, there needs to be multiple people involved in some cases.
Yeah. Okay, what else we got? We got a couple more segments. What else you want to talk about?
We're certainly going to talk more about, like you wanted to talk about self-employed, so we're certainly going to dig into that.
Yep.
And, we're also going to talk about, really, why is the fall such an interesting time for real estate?
Yeah, why is it
interesting?
Interesting.
And I also promised our listeners, I'm going to tell them what interest rate you should not take.
Not take. The high one, I said.
He said the high one. So we'll keep on teasing this. Maybe we'll save that for last. So you make sure you continue to tune in.
Mortgage 101, your guide to homeownership. We will be right back.
If you've liked what you've heard and you want to learn more, feel free to visit us online at teamclinton.ca.